Welcome back to the Babalian Money Show. Today we're tackling a massive question on everyone's mind. Are we in an AI bubble? And if not, how might one actually start? Before we dive in, a quick disclaimer. This video is for informational purposes only and isn't financial advice. Please do your own research before making any investment decisions. Now, let's get into it. The term bubble gets thrown around a lot, especially when a new technology captures the world's imagination. We saw it with dot-coms in the late 90s and arguably with crypto more recently. A bubble is essentially when asset prices detach from their fundamental value, driven by hype and speculative frenzy. Everyone wants in, not because they understand the tech, but because they fear missing out on easy money. Prices skyrocket, creating a sense of invincibility until pop. The bubble bursts and fortunes are lost overnight. So, is that what's happening with AI right now? It's a complex picture. On one hand, the excitement is palpable. Companies like Nvidia, which make the chips powering AI, have seen their valuations soar to astronomical levels. AI-related stocks are the darlings of the market, and venture capital is pouring into any startup with AI in its name. This definitely has the feel of the early stages of a speculative mania. The narrative is powerful. I will change everything, from how we work to how we live. And when a story is that compelling, it's easy for investors to get carried away. However, there's a crucial difference between the current AI boom and, say, the dot-com bubble. Back then, many companies had no revenue, no profits, and no clear path to either. They were built on pure hope. Today's AI leaders are different. Companies like Microsoft, Google, and Nvidia are generating massive profits. They are not just selling a dream. They are selling real products and services that are already being integrated into our lives. The AI revolution is already generating tangible economic value. The productivity gains are real. So, while valuations are high, they are at least tethered to something substantial. This isn't just hype. It's a genuine technological shift. So if we're not in a full-blown bubble yet, what would it take to get there? What are the warning signs we should be looking for? This is the core of our discussion today. How does a legitimate technological revolution morph into a dangerous speculative bubble? The first ingredient is what I call irrational exuberance 2.0. This is when the narrative completely overtakes the numbers. We would see a flood of AI companies going public, many with weak business models, questionable technology, and no revenue. Think of companies that are just eye-washing, slapping the AI label on their old business to attract investment. Investors would stop scrutinizing balance sheets and start buying based purely on the story. The media will be filled with tales of overnight millionaires, creating a powerful FOMO effect, the fear of missing out that pulls in retail investors who don't want to be left behind. This is the classic sign of a market top. The second ingredient is the democratization of speculative tools. In the dot-com era, it was online brokerage accounts that allowed everyday people to trade stocks easily. Today, it's commission-free trading apps, social media, and meme stocks. Imagine a scenario where AI coined cryptocurrencies or highly speculative, small-cap AI stocks become the talk of Reddit and TikTok. When your cousin who has never invested before starts giving you hot tips on an obscure AI company they saw on social media, that's a major red flag. This widespread retail participation, often driven by emotion rather than analysis, is the fuel that can inflate a bubble to epic proportions. The third, and perhaps most crucial, ingredient is easy money. A bubble needs a constant flow of capital to keep inflating. This usually comes from a low interest rate environment where central banks are pumping liquidity into the system. When borrowing is cheap, investors are more willing to take risks on speculative assets in search of higher returns. If we see central banks pivot back to aggressive rate cuts while the AI hype is at its peak, that could be the perfect storm. Cheap money combined with a compelling story is an explosive mix. It creates a feedback loop. Easy money pushes up asset prices, which attracts more investors, which pushes prices up even further. So, What would the pop look like? A bubble doesn't burst because of one single event. It's usually a combination of factors. It could be a major AI company failing to meet wildly optimistic earnings expectations. It could be a regulatory crackdown on AI technologies. Or it could simply be a shift in the macroeconomic environment, like a sudden rise in interest rates that makes borrowing more expensive and pulls liquidity out of the market. Once the selling starts, it can trigger a cascade. Margin calls force leveraged investors to sell, which pushes prices down further, causing more panic. The media narrative would flip from AI is the future to I was a scam. And the very same retail investors who piled in at the top would be the ones who suffer the most. The aftermath of a bubble burst is always painful. But it's important to remember that even after the dot-com bubble burst, the internet didn't go away. In fact, the strongest companies, like Amazon and Google, survived and went on to dominate the world. The same would likely be true for AI. A bubble bursting would clear out the froth and the weak players, but the underlying technology and the truly innovative companies would remain. The technological revolution will continue, just on a more realistic and sustainable foundation. So, how should you navigate this? The key is to be a discerning investor, not a speculator. Focus on the fundamentals. Look for companies with strong leadership, a clear competitive advantage, real products, and growing revenues. Don't buy a stock just because it has AI in its name. Understand what the company actually does and whether its valuation is justified by its financial performance and future prospects. Diversification is also your best friend. Don't put all your eggs in the AI basket, no matter how tempting it may be. A well-balanced portfolio can help you weather the volatility that will inevitably come. And most importantly, stay informed but don't get swept up in the hype. Separate the signal from the noise. The AI story is exciting, and it will undoubtedly create immense wealth over the long term. The danger lies in the short-term speculative mania that can accompany any transformative technology. By being cautious, doing your homework, and maintaining a long-term perspective, you can participate in the AI revolution without becoming a victim of a potential bubble. This is a fascinating topic, and we'll definitely be covering it more as it develops. What do you think? Are we already in an AI bubble, or is the best yet to come? Let me know your thoughts in the comments below. I read every single one. If you found this breakdown helpful and want to stay ahead of the curve on the biggest trends in finance and technology, make sure to hit that subscribe button and turn on notifications. It really helps the channel grow, and you won't miss our next deep dive. Thanks for watching the Babalian Money Show, and I'll see you in the next video.